The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Live Beginner's Course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
So let's discuss then how we can do that. How can we actually trade the price of oil? It sounds crazy, doesn't it? Sometimes just to think that I can go and look to invest in 5 barrels of oil. So if that price rises, I can make a profit simply sitting behind my trading screen. Well, the definition of a derivative will help to define that process. A derivative is a product which derives its value from an underlying asset. Okay, so simply deriving its value from an underlying asset. The derivative itself is simply a contract between two or more parties agreeing to buy or sell at a specific price, which is based upon or replicates the value of that underlying asset. The ability to trade derivatives on asset prices allow us to simply speculate on the movement of price without physically owning the asset itself. Okay, so we don't need to own the asset, we can just trade the price. So here we have two, I suppose, complex areas of financial derivatives, and obviously retail derivatives will be much more structured towards us. But I'll start with institutional derivatives. These are derivatives where the big players get involved because they're highly leveraged. There's a lot of risk involved with them. Potentially, they look to trade very, very large orders as well. So futures contracts as well, going from month to month or perhaps every 3 months, allow traders to look to speculate on the price of a commodity or an equity index or another asset, potentially 3 months or 6 months down the line. So it looks to book in those trades now. Options, again, are an agreement between buyers and sellers just for the option or the right to buy or right to sell a product if certain prerequisites are met. OTC, or over-the-counter derivatives, are large block trades, again, simply between two large institutions. Exchange traded derivatives, again, look, exchange traded funds. Simply, again, it's more in terms of large retail trading. Credit derivatives and interest rate swaps, they simply allow a level of lending for overnight lending between banking institutions where they charge a very small interest for lending very large amounts of money between banks. So those, you can see how they're of course advantageous within the institution itself, within financial markets, but how they're not so prevalent or available to us. We like to focus on retail derivatives. So the derivatives that are available to us are more like spread betting. So you may have heard spread betting or trading per point trading. Binary options, again, we can look to speculate on those prerequisites. Contracts for difference, again, are CFDs, simply a contract for the difference in price. And cash markets, which is simply the spot market. So you can still trade the spot market, of course, as a retail trader. You do need much more capital because you're physically trading the underlying investment. The most, I suppose, proactive type of cash trading we can do is equity trading, where it's more relative to investing, where potentially you are concerned with, I'll give you an example, concerned with owning 5,000 shares of Google because you see value in Google over the next 3 years. So you can make that investment. Of course, you're going to need 20,000 or whatever the amount is to invest in Google for those shares. And you're looking to hold those shares over a long period of time. So that's available to us as well. So let's break this down in terms of defining financial derivatives, first of all, and then we'll talk through the different types there in terms of retail derivatives. In understanding our role in retail trading environment, we can focus our attention on the various retail trading products available to us as retail traders. Many of these products, they carry very different features. Some have great advantages to the trader, while many have serious pitfalls. So guys, it's important to understand what we choose to trade and why. Okay, so we'll discuss spread betting first and foremost. Spread betting allows traders to simply place bets on the market. Bets are calculated at a price per point and assumed risk from one party, the trader, to the other, the broker. And we call that broker the market maker. So it's simply a bet. Total discretion is on the market price and liquidity is on the broker, which can have a very practical implication to personal trading. One advantage is, of course, that gains are, however, tax-free. So spread betting is effectively the same as making a pip, I suppose, pip per point bet. Just like you'd place a bet on, I don't know, a football match or a horse race or something, you're effectively creating that sort of agreement between one party, the broker or the bookie in this example, and you yourself as the gambler or trader. So it is a different approach to actually looking to trade the markets. And you can see that the broker there actually makes the market, just like the bookie actually makes the market for horse racing. It has a different sort of attraction to it as opposed to actually trading market liquidity. So very different in its construct. Binary options here enable traders to speculate on price of an asset at a specific time in the future. So we're not actually speculating on the price of this asset now. We can say, okay, the price of oil is $60 a barrel. I believe tomorrow it will be at $61, and I'll pay a very small fee to make that binary option trade. If the trade is correct, I'll make a profit. If the trade doesn't prove to be correct on expiry, and when the option is due, then I won't make a profit. I'll simply lose the amount that I've invested in that binary option trade. So with the construct of binary option, they are closely regarded to gambling because it's effectively a guess. Now, you could say it's an educated guess, that may be the case, but you're not able to manage trade positions at all. You're effectively locked into this guess. And in terms of how they're used in institutional trading, they're more for hedging outright positions. So that's why they're more referred to as gambling within the retail trading community, but they are advantageous for those traders who do like to trade them. Again, our preferred financial derivatives is a CFD, or contract for difference, because it allows traders to enter into a contract between buyers and sellers of an asset to speculate on the price. So very simple. All we're doing is speculating on the price movement. Although the market is synthetic, it follows underlying asset prices with a consistent degree of liquidity. Okay, so it's following the market as the market moves in real time, and we're simply placing this CFD or contract with the market. And then cash markets we have, which allows trading on physical shares and assets at full notional value. So just like I said there, if you're looking to trade Google shares, you'll need the full notional value of your investment. If you're looking to speculate on a move in a forex pair, then let's say we think there's going to be a move in the euro against the sterling pound, we're going to need the full notional value to profit. So you will need some capital to make very small profits, of course, of 5,000 or 10,000 euro to look to trade. And that is one of the main benefits that leverage provides us. We can start smaller accounts with 2 or 3 or 400 euro and actually access a much greater amount of capital to speculate. And this is one of the reasons why we choose to trade CFDs. CFDs are typically the preferred leveraged instrument to retail traders. Now, what does that mean? Leverage simply allows us to trade greater amount of capital than the notional amount that we start a trading account with. So if I start a trading account with 500 euros, I can involve myself trading in forex markets with some leverage, which simply means that I can trade a notional value of perhaps 100,000 euros or 20,000 euros per different trade, so that when there is small fluctuations in these currency pairs, the fact that I'm trading that size of capital allows me to profit and capture those moves. CFDs are available on a variety of asset classes, enabling more active opportunity and portfolio diversification. And that's most certainly the case. There are so many different markets to trade from, and that allows a lot of opportunity for us, so that we can, if we want to trade forex pairs, we can trade all the majors, all the minors. We can trade exotic pairs such as the South African rand against the Russian ruble. So very, very exotic pair, of course, that you wouldn't think of trading, but if it's moving and you can assess the opportunity correctly, well, you can make profit in a move like that. CFDs are quite cheap to trade, particularly with Forex, and that is very much the case. If you're trading something like the euro dollar with a 0.01 lot, effectively that's the leverage. We'll call that 1,000 euros of notional value. It might cost you 3 or 4 cents to make a trade, so very, very cheap, of course. CFDs allow both long and short selling, so if you're potentially unaware with leveraged products, you're able to take both sides of the market. Now, what does that mean? Well, effectively, it means that, of course, you can choose to buy the currency pair. So if the price appreciates or rises, you're going to make a profit when you get out of that trade or you sell it again. However, you're not physically owning the capital or the trade again. So because you're not able to physically own something, you can take both sides of the market. So if you believe that the price of oil is going to go down, you can speculate that the price is going to go down, take a short position, and then exit that trade at a lower price to actually profit from a move to the downside. So very advantageous when there's a lot of volatility in the markets. So let's discuss these markets then as main asset classes, and we'll go through them individually to discuss the opportunity available to us as traders. Forex markets are of keen importance. We can trade commodities, we can trade equities and equity indices, bond markets, and a new, I suppose, asset class which has risen to fame over the past 2 years is, of course, the cryptocurrency phenomenon. Now, they are providing fantastic speculation and trading opportunity, and actually they're proving to be quite technical, which means they are seeming to adhere to technical analysis. So a lot of traders are actually performing quite well when trading cryptocurrency. So it's something certainly that more and more traders are starting to bring into their asset class portfolio when looking to trade the markets. So first and foremost, let's discuss then Forex, because they're quite popular, of course, and I would recommend, of course, this is the first asset we would look to begin our trading in. They are regarded as safe haven, as just like cash. Okay, so some some currencies are regarded and have that safe haven approach, and simply because cash is king. You want to remain liquid, which means, effectively, investors or traders have a level of comfort when they exit a position because they have that position as cash now. So it has that level of safe haven. It provides a return on investment, of course. Trading is focused on strength versus weakness of one currency to another. So that's effectively what you're trying to do when you're trading euro dollar. You're trading euro strength versus dollar weakness, or vice versa. So you can look to exploit either strength or weakness, or potentially both, across these currency markets. Typically the most volatile of all asset classes with constant price movement, and that is certainly the case, because so many, I suppose, data points, all the news flow that will come into the market during the day has a degree of movement in the forex pair. Just because it affects trade flow, it may affect the underlying health of the economy, it may reflect things like inflation or interest rates, and they'll all move according to perceived expectations. So there's a fantastic amount of volatility in the forex markets, and that's potentially why they're so common and favored to trade, and an unquantifiable amount of economic variables that formulate price discovery. So they're moving all the time. Foreign exchange currencies always trade in pairs. Just to summarize again, so you can't simply look to trade the euro. You may hear people saying, well, I see euro strength in the market because Mario Draghi, the ECB president, has said this, or because we had very strong economic data from the EU. I want to buy some euros. I want to trade the euro. Well, you're effectively not able just to buy euros. You'll be looking to trade the euro against another pair, so against the dollar, or against the pound, or against the Canadian dollar. They always trade in pairs, so that's very important to understand. I'll give you an example of this. So here we have the euro US dollar. Okay, so to the left, then we have that as the quote currency, and of course the base currency there. The currency price quoted is the value of the first listed currency, the base currency, relative to the second. So it's always relative to the movement of the second currency pair. And what this means here with a 1 1.23376. It literally means that €1 is that value. So €1 is effectively $1.23376. Okay, that's going to be the same for other currency pairs when you see something like this, the US dollar against the Japanese yen. Well, what does that mean? Well, it simply means that this is our base currency here, that $1 is going to equal this amount of Japanese yen as the price moves like this. Okay, so very simple, but it's very important to know that your first currency pair there, your base currency, is effectively 1 unit of measurement against the second here, the second currency pair. And that's how we look to trade strength versus weakness across these currency pairs. So with commodities then, a wide variety of global commodity prices. So not just gold, not just oil, we have different metals, we have different softs, like different grains, coffee, sugar, wheat. So many different commodities that you can choose to trade, and it's great in terms of understanding supply and demand. So we call these commodities energies. So your petroleum-based products like oil, natural gas, RBOB, and then you have metals such as your aluminium, copper, zinc, uranium. Soft commodities, again, like mentioned, your grains, sugars, wheats, cotton, coffee. So a huge array of different markets to trade, and that's very advantageous that when you have an MT4 trading platform, which we'll discuss throughout the lessons, guys, the more markets you have to trade, well, the more opportunity there is there for you. With commodity markets, prices follow swings in supply and demand, so they are very related to what affects their price in terms of supply and demand, and a key function of global physical trade and reflect global outlook. And that's effectively what we're seeing at the moment. We are, of course, in a very strong bull market. We're starting to see as there's more spending, generally in the economy, it's a more healthy economy. There's more spending on commodities. If you think of one market, perhaps let's choose a market like the coffee market. It's a global commodity. Well, the healthier the stronger the economy there, let's say in the United States, the more consumer spending they will have. So the more likely to spend, money going to work, buying a coffee. All these companies like Starbucks and stuff will produce more of their product to meet that demand, and that will create more demand in the commodity itself, in coffee, raising the price. So it is a key function of physical trade reflecting the overall global outlook. A key function of domestic economic performance, again via import and export, and some of those countries are huge exporters, which really supports the overall growth story of our sectors of the economy. Oil is, of course, a very strong example for Canada. Wheat is, of course, a very strong example for countries like France. They're huge producers of that commodity. Often they provide excellent opportunities. Factors affecting them can change rapidly. So if we think of weather, perhaps if we have a shortage of rain, that can cause a drought, and that can cause shifts in demand, causing things like seasonality, huge shifts in price. Let's move on then to equity and equity indices. Then we'll have equities that are designed to raise operating capital for the issuing company. Investment then facilitates global growth and business. Equities are exchange traded and are having various opening and closing times. So because you trade equities on an exchange, of course, they open and close there to different times across the world. So here in Europe, they'll open at 7 o'clock in the morning with the futures, but then the cash markets for equities open at 8 a.m. European time, and will continue to trade then throughout the course of the day to their own closing times. Depending on the market, of course, it's around 4:30 for European closing equity times. Speculation on investment aims to make a return. So return on investment, or ROI, it's effectively what you're doing when you trade in these equities. You're looking to make a return on investment, ROI. And equity indices particularly are collectivized and tradable as indices. They're reflecting top performing companies and macroeconomic activity. In the US, we have the S&P 500, which is the 500 largest companies in the US by market cap. The FTSE 100 in the UK, the Dow Jones Industrial Average there in the US again. We have the German DAX, we have the French CAC 40. So they all reflect, top performing companies within each nation. Specifically, equity trading refers to the trading of company stocks and shares accessible via the cash markets. This is investing and also accessible via the retail trading market. So we can trade even single equity stocks on an MT4 trading platform. Of course, guys, we can trade simply with a CFD, the price of Google or the price of Microsoft, all of these companies, to actually look just to profit on the movement of price without physically owning anything. And that's the point I'd like to make, that equity investing focuses on the physical purchase and ownership of company stock. As technical traders of price action, we prefer to focus on price speculation. So we're just simply interested in making money when the price moves. So here we have an example. Here we have the FTSE 100 market. Each of these little graphs that you see here, these little what are called Japanese candlesticks, guys, and we'll discuss these in later lessons here. These here are the Japanese candlesticks. So the green ones are simply when prices move to the upside. So this is when prices are rising, and the red ones are here where you can see a collection of red ones when prices are moving to the downside. So this is reflecting a weak market at this period, showing that the market is actually trading down, and you can see the price here is on the the right hand side, showing prices moving to the downside. Okay, so that's effectively how we look to speculate and find opportunity in these markets. Government bonds, guys, we can also trade government bonds. So I'm sure many of you guys weren't aware of this, but we look to actually trade the price of government bonds. Now, this is simply the issuance of government debt to fulfill borrowing requirements. Governments must borrow to run national affairs. So, of course, if a government wants to, build bridges, if they want to build libraries or increase expenditure on education, they might actually go to the market and sell debt, issue debt, so that people or financial institutions or other governments will effectively purchase that debt and invest in for a rate of return in that bond. So in effect, then the government's sell or issue government debt over a fixed term period. So we have 2-year bonds, 5-year bonds, 10 years, and even 30-year bonds, and they all have a different level of return. Bonds are auctioned at markets to determine price. This reflects the economic outlook and stability of each region as a function of perceived risk. When there is a greater risk and more uncertainty that a region will not be able to repay its debt, the market will demand a much higher rate of return, which is known as the yield on the debt issuance. So it's very simple. That's the construct of a bond. So if you think of it just between two parties, if you have a friend and you decide to lend 100 euros to a friend over 2 years, well, you're going to expect a level of return on that 2 years. However, if you're going to lend that same 100 euros to the same friend for 5 years, because you're not going to see your money returned to you for another 3 years, for a much longer period of time, well, you're going to demand a slightly higher return on that. So that's effectively how these bonds are priced. And again, depending on the level of risk of that friend that you may have there, that perhaps he's unemployed or he's not able to pay back the amount with a certain time, that will factor into pricing your level of interest as well. Moving on then to cryptocurrencies, again, very common in terms of how we've seen these fluctuate in price and how popular they are as a new asset to trade. Digital currencies, they're tradable in some regions, particularly there in Asia and Australia, in lieu of cash. So you can actually go to the supermarket and buy your groceries there in a cryptocurrency. Tradable, they are on private mining exchanges online and now entering as CFD or futures contracts. Okay, so we can trade CFDs for us as retail traders on our trading platform and speculate on these movement of prices. They're tradable 24 hours a day, 7 days a week. So it's one of the first markets effectively, because it's not on an exchange. We can effectively look to trade these markets 24 hours a day, 7 days a week. Now, one point, they are very volatile and given their trading conditions. The products are relatively new to the market and are not entirely understood. Okay, so there is some speculation too. Well, what is Bitcoin? What we know the technology, what the technology is, but what is the underlying fundamental strength? What is the reason for it to be priced at $7,000 or $9,000? So that is of concern for the market, and that is one reason why it's quite volatile. Large percentages of the markets are owned by very few big players. So those who own the actual physical bitcoins as well, some of them are the large percentage owners of the entire market. So that's of concern as well. And driven by technological growth, we can say it has possible bubble speculation, as we've seen the rise in price there to 20,000 and then reverse down to around 7,000. There are huge amount of volatility in that market, in particular over the last 6 months. We're not actually able to take short positions on most of the available currencies. However, things like Bitcoin, Litecoin, and Ethereum, of course, we're able to take short positions now because they're CFDs. Okay, so with the CFDs, of course, we can actually look to trade both sides of the market here. So here we have market selection. So we just talked through then, and I hope we've just got a bit of an understanding to looking at the different markets that are available to trade. That we can trade Forex, which is simply capital related to one currency or another. We can trade a different array of different commodities. We can trade equities and equity indices, bonds and cryptocurrencies. So many traders do struggle to choose which markets to trade, or even worse, they try and trade all of them at the same time. So it's very important to really reel yourself in. When you are a beginner trader, I would recommend placing maybe 3 trades a day or something like that, just to don't overcomplicate things. Learn more about the markets at a practical level, and choosing market selection more acutely. Institutional trading attempts to build diversified portfolios over a combination of asset classes, choosing the best perceived trades at the right times whilst trying to conform to a suitable level of risk. Okay, so it's always about risk. Most retail traders often trade on gut feeling with no relation to diversification or risk allocation to one particular asset. In correcting these flaws, we attempt to protect capital and ease variance so as to develop consistent performance. Now, I realize this is probably a little, too much to take in, but I wanted just to finish off this few lessons just with some discussion about, being more aware of the risks involved and discussing market selection, because even if you download a demo account, choose a few markets to trade, get used to them, whereas opposed to just looking at a market saying, well, this market looks like a buy now because it's really, really weak, it's selling off, perhaps it's going to bounce, or perhaps I have a gut feeling about this trade without no relation to what the market's doing. So don't overtrade, choose your markets carefully, and do get involved in terms of your consistency. So that leads us then nicely into asking, I suppose, the main question we get asked here from lesson 1: what markets to trade? So what market do I trade? What's moving? What market do I trade? Well, the answer is there is no right or wrong answer. As traders, we strive to become better decision makers. Acquiring education and knowledge will certainly help us with this. So you've made a correct choice already, guys. Starting this beginner's trading course here with webinar 1 tells me that you're interested in your education, and of course, you're hoping to effectively become a better decision maker over the long term. That will hopefully certainly be the case. Fundamental knowledge of a market will help your understanding of entering the market at the right time. That is particularly the case for many different assets. For equity markets, if you are an expert at trading one of your favorite equity markets like the FTSE 100, or if you're from Germany, you want to understand the DAX because you want to understand all the companies that make up that equity index, you're going to have a level of understanding better than other market participants and will be able to trade more effectively. Technical analysis will help answer both the what and when. So this is really the study of price action, which we'll be detailing throughout the beginner's course. Very enjoyable study indeed. It provides insight into how markets move and where prices are more likely to move to. Okay, so more likely to move to. You might have heard discussion about, well, what is trading? It's really to increase your probability of a successful outcome. That is what technical analysis aims to do, and if of course you can do that, making more high probability trades, you will become a successful trader without a shadow of a doubt. So that concludes this webinar, guys. I hope you've enjoyed it. It was quite introductory in terms of its structure, but it will get much more exciting, of course. What do we look to conclude with this webinar? What did we learn, of course? Why do we trade the financial markets? Of course, we all have different objectives when approaching these markets. What is important is to define your own personal agenda. And then we understand that our role effectively is a retail trader within this environment. So we don't have the same shift or strength as the central bank, of course, as a market participant does. We don't have the same amount of capital as these institutional banks do, and we're not able to move markets. So we know that we can just get involved making profits when the big players decide to move the markets. Okay. The use of financial derivatives, hopefully that helped us define and understand the advantages to a contract for difference. It simply allows us guys to trade and speculate on the movement of price. So it's a contract between buyers and sellers in the markets. Without physically owning any of these assets, we can simply trade the price. And then what we can trade. So we looked at the different asset classes the whole way up to cryptocurrencies. So we can trade cryptocurrencies, bond markets, single equity stocks like Google, Microsoft, Santander, Deutsche Telekom, a whole plethora of different stocks to trade. We can trade them in equity indices as well. And of course, we can trade Forex markets, which are always moving in relation to new news flow. So that concludes our webinar. Then in the next webinar, we'll be discussing what is all the fuss about, and that will lead us then to discuss the battle for price action. And we'll be looking at Japanese candlesticks, and we'll be making decisions both as trading agents to whether we want to become buyers or sellers in these markets. So that concludes this webinar. Congratulations, we have now finished the first webinar of the beginners trading course. So well done. That's all good. I'll let you go. Enjoy the rest of your day there. And if you are trading the markets, of course, good luck in the markets today. I'll see you at the same time with the beginners trading course lesson 2, webinar 2 tomorrow. From all of us here at Forex Academy, then do have a great day. Thank you for joining us, and we'll see you next time. Bye for now.